Dimitri, for inviting me. Yes, thank you so much to the organizers. And as you can see from the screen, this is a joint work with Jie, Amit, and Elaine. My name is Xintong. I'm now with the Fudan University. And in this paper, as you can also judge from the title, we are trying to study the pricing of ESG, which is a form level characteristics in the options market. As Dimitri just said, there is a faster growth of the ESG investing or so-called socially responsible investment. And in this figure, I'm showing you the principles for responsible investment signatories. So for those who are not familiar with this PRI thing, it is a network, investment network that is supported by the United Nations. Okay, it is founded in 2006, and then in around 15 years, there is a faster growth. This orange line is about the total, is about the number of signatories, and the blue bar is about the total assets under management. And as you can see, by the end of 2021, there are around 4,000 signatories. So around 4,000 institutions and money managers have signed to be a member of the PRI. So they are committed to do investments that are socially responsible. In total, those investors have around 120 trillion US dollars under management. So this is a fast growing kind of phenomenon, and this is a huge major investment style in recent days. And one of the major objectives for those investors or the institutional investors is that they want to enhance the return while manage the risk, because low ESG performance or poor ESG performance could lead to a lot of risk. The most common one that you may have in your mind is the litigation risk. The firm is not operating in isolation. It has to interact with the community around. For example, we have one company, which is the KCM company. This is a mining company, and it has some business in Zambia. And in 2015, a group of around 2,000 Zambian citizens decided that we are going to sue this company because the company's operation hurt their health and also the farming. The company has repeatedly discharged toxic emission from their business to the watercourse. And this watercourse has been used by those citizens for drinking and irrigations from 2005 to today. And this is really a big thing for those citizens. That's why we have this kind of litigation risk. You may also think of the regulation risk. For example, a lot of governments are talking about whether they should impose carbon tax for the companies that emit too much carbon, all right? And reputation risk, I don't know whether you know Alibaba, but if you are from China, definitely you know that. This is an influential high-tech company. However, its reputation is a little bit bad because of the corporate culture. So Alibaba didn't treat its employees in the best way, and there is almost no work-life balance among those employees. And last thing is supply chain risk. All right, so the firm has to import some products from the supply chain, and the US customers and border protection claim that they won't allow the companies to import the products that are manufactured by forced or endangered labor. So those examples are just some risks that you may have immediately in your mind because of the poor ESG performances. And those risks certainly increase the uncertainty of the stock returns because we don't know what is the content and timing of the regulation changes. So it is very difficult to predict the regulation changes. It is also difficult to measure the damage of the reputation risk. So the Alibaba's culture will be difficult to measure in the reputation risk way. So it's already an intangible asset. And those two things are about the downside. At the same time, we couldn't ignore the upside opportunities. So not all the low ESG firms are going to face the downside risk. And they may also have some upside opportunities. According to Lauren Cohn's recent working paper, they argue that the low ESG firms have to transform, so they have to change, and they have more incentives to innovate. For example, they can create more green patents than the other companies. And this means they may have upside opportunities. In this case, the ESG performance could have some kind of relation with the uncertainty of the stock returns. And we are trying to study this topic in the options market. Specifically, we are going to ask whether the investors in the option market recognize those ESG-related risks when they are trading the options. Of course, we won't be able to decompose those risks into different categories like what I showed you earlier, reputation risk, regulation risk, but at least we can test whether the investors perceive those risks. And after that, we would like to see what is the pricing of the uncertainty associated with ESG, again, in the options market. Given there is risk, or given there is upside opportunity, the option traders may want to pay a premium to hedge or speculate on such uncertainty. So we hope to quantify such kind of premium. And as you can see, we are not going to look at the stock market or the other kind of market. We are only focusing on the options market because option market is just a natural place to study the pricing of uncertainty. There are several papers, for example, Kelly et al. 2016 and Pesta and Varanasi 2013. So they look at whether political uncertainty is priced in the options market, and they indeed find some evidence. And in this paper, we are trying to catch the trend. We are going to look at whether ESG risk is priced in the options market and how much is the magnitude. So by looking at the ESG risk in the options market, we hope to understand how the uncertainty are perceived by the investors and how they are ultimately priced in the options market. All right. Yeah, before I go into the details of the results and the empirical part or anything I would like to talk about, let me first show you a few pictures, okay? So the first picture is about the implied volatility difference between low and high ESG stocks over time, all right? So you can see we have something starting from 2013 until 2018. This is the timeline. And our interest variable is the difference in the implied volatility of the low and high ESG stocks. So the implied volatility of the low ESG stocks minus the implied volatility of the high ESG stocks. And you also see that this timeline is split into 3 parts. Okay, so what does PA mean? It is the Paris Agreement. So we have before Paris Agreement, in Paris Agreement, and after Paris Agreement. This is, of course, analysis about the US market. All right. So the
Xintong,
Paris Agreement. Yeah.
Can I interrupt you? I think you're still on the options to the uncertainty, the text slide. Let's see whether you, at least I don't see the figure. So let's try to move through the slides and see. Maybe we need to reshare them.
So you couldn't see the figure. So
the figure, right? So try to move to the next slide. We're on slide 4 right now, at least what I can see. So maybe try to reshare the slides.
Sure, because I'm already on the
slide 5.
Yes, I'm sorry. Let me do this. How about
because
now?
I do want to see the figure because it's probably, I like figures.
Thanks for the reminder. I didn't. Yeah, I couldn't see your screen, of course. Yeah, I'm seeing that I started to share it, but it's not working yet.
Oh, now we see the figure, right? So it's before,
right.
In, and after.
Brilliant. Yes. Okay. So the Paris Agreement is one of the most important milestones in our kind of fight against the climate change, right? And this is also a kind of surprise because even just during the evening of the Paris Agreement, before its announcement, people were still wondering whether the countries can reach an agreement at all, because there are so many countries and they have their own incentive. Eventually, we reach an agreement. This is kind of a surprise, all right? And the Paris Agreement has been used as natural experiment in many papers. That's why we are also using this Paris Agreement. However, the climate change to President Trump is not important at all. And he also claimed that the climate change is just a hoax. Therefore, in the mid of 2017, President Trump said we are going to withdraw from the Paris Agreement. And therefore, we have the after Paris Agreement period. All right. So what does this line tell us? First of all, there is already a gap in the implied volatility between low and high ESG stocks. Okay, so the implied volatility of low ESG stocks is already higher than that of high ESG stocks, indicating that those options of low ESG stocks are a little bit more expensive. When we have the Paris Agreement, in this period, people pay more attention to climate change, and they also expect that there will be more stringent regulations towards the firms with low ESG performance. This gap increased from around 10% to 16%. And after US decided to withdraw from the Paris Agreement, as you can see, people have a lower expectation about the stringent regulation. The gap reversed to the normal level. All right. So with this figure, one thing that we can conclude is that the options of low ESG stocks becomes more expensive compared to high ESG stocks after the Paris Agreement. When people are paying more attention to the climate change, when they believe there will be a higher regulation risk related to the ESG stocks, there will be responses from the option prices and its implied volatility. So this is the first figure I would like to show you. Option traders indeed perceive the risk related to the ESG performance. And the second figure I would like to show you is the option implied volatility around Greta Thunberg's speech. So Paris Agreement is really a big thing. There could also be some time trend. How about some smaller events? And this is actually not very smaller given that Greta Thunberg is really influential as a climate activist. Okay. So she is a Swedish teenager, and she is also famous for challenging the world leaders for not doing much about climate change. And in our paper, we look at 10 of her most influential speeches. All right, so this is not only one speech, we have 10 speeches, and we are going to look at how the option implied volatility changed around her speeches from 10 days earlier to 10 days after. Okay, so day 0 is the event time. Consistent with the earlier evidence, there is already a gap. So the implied volatility of firms with low ESG performance is higher than that of firms with high ESG performance. But again, this gap gets enhanced and increased after Greta Thunberg's speech. This is definitely not a long-lasting kind of effect, given it is only a speech. But there will be a short kind of increase in public's attention to the climate changes or the ESG performance of the firm. So again, the options of low ESG stocks become more expensive compared to the ones with high ESG performance after the Greta Thunberg's speeches. Okay, so when people's attention is high, investors are likely to perceive that risk, and such kind of perception will be reflected in the options price. And the last one. All right, so our paper is not only about the environment part of ESG. So we also have the social and corporate governance part. And another figure that I would like to show you is the option implied volatility around the Me Too movement. And this is, of course, an event related to the social justice and gender equality. We believe the event time is October 15, 2017. This is also the time when the hashtag #MeToo is widely spreading on Twitter. All right. So this is the event time 0, and from 10 days earlier to 10 days later, you see the trend. And consistent with our earlier period, when people are paying more attention to social justice issues, the options of low ESG performance firms are also becoming more expensive. All right. So those 3 figures are very intuitive, and we don't have any control. However, it just shows you whether the investors in the options market perceive the risk related to the ESG performance. And we find some evidence, yes. So the option expensiveness as measured by implied volatility is higher for low ESG stocks. And Delta-hedged option returns, which will be our main focus in this paper. All right. So delta-hedged option returns help us to take out the effect of the price movement of the underlying stocks. So we can focus on the option pricing only. We find delta-hedged option returns is lower for low ESG stocks. It is consistent with the evidence in implied volatility. So a more negative delta-hedged option returns means that the options are more expensive compared with its underlying under the Black-Scholes model. All right. Given that we have a quite broader concept of the ESG, we find that all of those three components of ESG contribute to the option pricing. Just as I showed you earlier in the figure, E matters, S also matters. And G is the weaker part, but in our regression, the corporate governance index also matter. And we have several kind of natural experiment, the Paris Agreement, Greta Thunberg, and Me Too movement, we find kind of consistent results. Why investors would like to pay such a premium? Because they want to hedge. What kind of risks are we talking about? When we look at the nature of such risk, we find investors pay the ESG premium. So the low ESG stocks options are more expensive because they want to hedge volatility, jump, and other higher moments risk. We also do a lot of heterogeneity tests, and we find the results will be stronger for firms that are closer to the end customers when they face severe product market competition and when they have a higher ESG awareness. So in all those situations, the ESG performance will matter more for the firm, and therefore we find a more pronounced effect of ESG on option pricing. And lastly, if the firm is actively managing, if they are actively managing some risk, no matter it is related to ESG or not, we find that the results, the effects of ESG will be a little bit weaker. So those are our main findings. We hope that with this paper, we can link to at least the two kind of literature. The first one is the impact of ESG on financial assets. And there is a growing literature about this topic, but such kind of topic can be traced back to around 10 years ago, right? When we look at the stock market, we have at least two very famous papers by Harris Hong and Martin in 2009 and by Edmonds 2011. 2011. And those two papers find something different from each other for sure. And even today, how ESG affects the stock market or the price of the stocks is still kind of controversial. And there are recent theoretical papers talking about the level of ESG awareness and also the portion of ESG investors. So there will be more and more paper about this topic, I think. And secondly, there is also a growing literature about the bond market. If you are interested, you can look at the Flammer 2021 or Duan et al. 2021 when they look at how the carbon emission affects the bond returns. And for sure, well, we think that we are the first one that to study the impact of ESG on the risk premium in the options market. So we expand the ESG investing study from the kind of major investment vehicles to derivatives. And we still find that even if we do delta hedge, there is an effect of ESG on option pricing. When we talk about option pricing, there is a growing literature as well. And we have to thank the derivative workshop organizers for promoting such kind of research. The option return predictors include a lot of things, and the most important ones will be the underlying stock return and the distribution of those underlying stock returns. And for our paper, we document a new firm characteristic. This is not a financial performance. It's a non-financial performance, which is the ESG that can affect option prices and the returns. And our argument and the channel is that the ESG performance will affect the option traders' demand for hedging or speculation, and that's why it is priced in the options market. And those are the two trends of literature that we hope to contribute to. And there is one paper. This is a very nice paper that is an RFS paper by Ian Saltner and Vilkov in 2021. So in this paper, they also look at the options market, and they use risk neutral quantities that extracted from the options to study the pricing of carbon risks. Specifically, they talk about the pricing of the downside risks. And how is our paper different from their study? First of all, we focus on the broader ESG concepts. It's not only about environmental related risk, we also have the S and the G part. As I mentioned earlier, all those three components contribute to the pricing of the options. Secondly, we don't just look at the downside risks. We focus on the overall uncertainty like the volatility, jump, and other higher moments. And the third one, we focus on the option returns to quantify the magnitude of the ESG premium rather than just look at the downside risk. And then lastly, we explore a lot of potential underlying channels by doing a lot of cross-sectional tests. And one empirical fact that I would like to mention is that when we run our mean regression, when we control for carbon emission that is in Ian et al. 2021 paper, we found that the ESG results still hold. However, the carbon emission effect kind of is observed by the ESG performance. Later, I will show you the results. All right, so this is how we contribute to the literature and how we can be different from existing paper that links carbon emission with the option pricing. So now let me talk about the data we have. All right, the data, if you are doing ESG related study, you must be very familiar with the following a few data. And our main focus will be the Thomson Reuters SS4 ESG data. This database provides kind of quite objective and relevant systematic ESG information based on a variety of key performance and also kind of individual data points. This is a global kind of ESG data provider. For our study, we focus on the US part. At the beginning, SS4 covers only the S&P 500 companies and then expanded to Russell 1000 index. And this means we still have sufficient diversification and the number of stocks in our sample. So for example, in every month, on average, we have around 300 stocks. So we don't have under diversification issues. One thing that one concern that a lot of people have for this ESG study is that different data providers usually have kind of different performance evaluation methods. So their evaluations, their scores for one firm, for the same firm, can be quite different. Okay, to address such kind of concern, we actually look at 4 alternative data providers: the KLD, MSCI, Sustainalytics, and RepRisks. So if you are interested about those database, you can just look at our paper. We have a clear session. We have a small session about the differences, and yeah, we have some description about those data vendor. So we can combine those data together to extract the common part and show that our results hold, or we can use them separately. Still, our results are largely consistent. All right. And even if we are going to use those alternative data as an IV for our mean data, which is the SS4 ESG score data, we can still find the results. So it seems that data is not a concern for our study. No matter what kind of data we use, we always find the same conclusion that options of low ESG stocks are going to be more expensive. Option data, I guess, yeah, the audience should be quite familiar with it, and the other data is also quite standard. So this is the data we are going to rely on. The measures, besides implied volatility, we focus on the Delta-hedged option returns. And we follow Bakshi and Kapadia and Cao and Han to construct these delta-hedged option returns. Specifically for call option, this return means we are going to buy one call option and sell delta units of the underlying stocks, rebalance the daily, and then the residual part will be earning a risk-free rate. This is the delta-hedged option gain. And to make this gain comparable across different stocks, we are going to scale it by dividing the initial investment, which is delta unit of the stocks minus the call options price. And you can do the same thing for the put options. And according to this equation, a more negative delta-hedged option return indicates a more expensive option price relative to the underlying stocks under the Black-Scholes model. All right. And this is the summary that we have. Consistent with the literature, the average delta-hedged gain till month's end is going to be negative. The option writers are charging a premium. All right. And we have at-the-money options, for which I didn't mention much. So we only focus on the at-the-money options. And at the end of each month, we are going to select quite standard options that will expire in the on the third Friday of the next 2 months. It means if we are standing in the end of January, we are going to look at the money options that will expire on the third Friday of March. All right. And to make sure that the information for the market, for the options is kind of complete, there is no bias, we make sure that we have a pair of call and put options together. So that's why we have the moneyness that is close to 1 and the days to maturity that is very close to 50 days. For the ESG score, the Thomson Reuters SS4 data has a range from 0 to 100. And for our analysis, we simply scale it by dividing 100. And those stocks are quite large, as you can judge from this institutional ownership and analyst coverage. So if there is going to be any mispricing or limits to arbitrage, the effect should be a little bit smaller, given that they are quite large stocks. All right. The results. For the return analysis, we are going to run pharma-max-best regressions. So very simple regressions here with the delta-hedged gain as our dependent variable and the ESG performance of the underlying firms as our key interested variable. As I mentioned earlier, the ESG performance should lower the price of the options. And in this case, the delta-hedged gain should be higher. So we can expect a more positive beta here, the coefficient here. Low ESG score is associated with more negative delta-hedged gain, indicating that investors are paying a premium on these options. So if we have a positive beta, we are going to confirm this hypothesis. And this is indeed what we have in the data. So when we look at call options or put options, with controls, without controls, no matter what we do for this regression, we always find a significant positive relation between the call options, delta-hedged gain, and the ESG score. And this magnitude is not small as well. If we increase the ESG score from quarter 1 to quarter 3, so 25 percentile to 75 percentile, the delta-hedged gain will increase by 0.32% for call options, which is actually equivalent to almost 15% of the standard deviation. So this is not a trivial effect. The results are the same for call and put options. Again, with this regression, with those positive coefficients, we can confirm that options of low ESG scores are going to be more expensive. For the Paris Agreement event, we can use it in our pharma-max-best regression as well. And we hypothesize that the impact of the ESG on option prices should be amplified after the Paris Agreement but get reversed or mitigated after the announcement of withdrawal. And we have 3 different periods: before the Paris Agreement, in the Paris Agreement, and after the Paris Agreement. For each of these periods, we are going to run our Feynman-Macbeth regression and obtain the relationship between ESG score and the delta-hedged gain. As you can see, before the Paris Agreement, the score has a kind of smaller effect on the option pricing. And in this Paris Agreement, the coefficients get much larger, even though the difference between those 2 coefficients are not quite significant, but at least we have a correct kind of direction. And after the Paris Agreement, the effect of ESG even become negative, even though it's not significant. And if we compare in the Paris Agreement period with the after period, we will find a significant difference between those 2 coefficients. And the results are similar for put options. Okay, so it means the coefficients of ESG score increases in the PA and decrease after the withdrawal. Even though we only have limited number of the observation, we still kind of find some supporting evidence. So this is the effect of Paris Agreement on our documented finding. Again, you can complain about this is only one-time shock. There could be some time trend. So another thing that we try to do in this paper is to make use of the exogenous shock on firm level ESG risks. So how we find such shocks, we make use of the RAP risk database. This is a news-based database that we can identify firms with sudden increase of ESG incidents. And the firms with ESG incidents are probably going to be a little bit different in the ESG performance compared with the ones without ESG incidents. However, we are trying to argue the timing of such kind of ESG incidents are going to be exogenous. It's not going to be controlled by the firm. And therefore, we can still rely on this kind of events as exogenous shock on firm level ESG risks. If, according to the database, a firm has a sudden increase in the ESG incidents, we are going to treat them, label them as the treated firm. Then for each of the treated firm, we are going to find a control firm according to the PS matching process. Then with the treated firms and the control firms, which are already matched according to several fundamental variables, we are going to run the difference in differences analysis. And our interest, the focus will be the interaction terms. Okay, if indeed option traders will perceive more risk when the traded firms have ESG incidents, this beta 1 will be negative, indicating the option price are more expensive, delta-hedged gains are going to be more negative. And this is indeed what we have found here. But here we are not doing Feynman-Macbeth regression, we can only do the panel regression, and our results are consistent with our conjecture. Option returns becomes more negative for traded firm after the severe ESG incidents. No matter we add controls or not, this magnitude is kind of quite stable, which also support our use of those shocks as exogenous events. All right, so with the Paris Agreement and exogenous shocks on firm level ESG risks, we hope to convince you that the ESG related risks is indeed perceived and priced by the option traders. Yeah. Our paper is not about the environmental performance only, even though we have Paris Agreement and the Greta Thunberg. In our paper, we actually show all of those 3 aspects of ESG, which is environment, social, and corporate governance. All of those pillars matter for the pricing of options. When we look at the E and S and G score separately, the most important ones will be E and S. Even though the G score is also in the right direction, the significance is a little bit lower. So we couldn't just ignore the social justice for sure in the option pricing. And we are quite ambitious. We hope to measure, quantify the magnitude of ESG premium in the options market. So we follow the standard asset pricing literature. We are going to form portfolios, but the delta-hedged gains are going to be, the dependent variables are going to be daily rebalance the delta-hedged option returns, right? So this P1 to P5 means the ESG scores increases. So P1 represents the group with the poorest ESG performance, and P5 is the one with the best ESG performance, okay? And as you can see, the average return increases monotonically, even though they are all negative. Yes, the option writers are charging a premium, and we have a spread which is around 30 basis points. This is the average return. We can, of course, include the risk factors. We can have 6-factor alpha, which is adjusted for the Fama French 5-factor plus the momentum factor. We can also add another factor, which is the volatility factor. But again, we find a significant spread here. For put options, the results are a little bit stronger. Maybe there are more hedging behavior using the put options. But the bottom line is that with this portfolio sorting, we find ESG premium, which is around 0.30% every month. Okay, so this is the magnitude of the ESG premium. Investors are paying 0.3% a month more for the firms with low ESG performance. And what kind of risks are those investors trying to hedge or manage? Options are kind of very nice tools because we can construct all kinds of vehicles that are exposed to different risks. So in this table, we are trying to make use of the straddles that are only exposed to a certain risk. So we construct straddle returns that are only sensitive to volatility risk, or that are only sensitive to jump risk. If ESG is kind of affecting such kind of straddle that is exposed to only one type of risk, it means at least those investors are trying to hedge such kind of risk related to ESG. As you can see, ESG is positively related to the volatility risk sensitive straddle, and also positively related to the jump risk sensitive straddle returns. But the magnitude for the jump risk related straddle returns is kind of stronger, indicating maybe the higher moment is slightly more important than the volatility risk in our analysis. All right, we have been arguing about this investors' demand. So they may be hedging, they may be speculate, can be tested directly. Yes, we could do that. So what we are trying to do here is to make use of the option and users' demand and show how it is related to the ESG performance of the firm. We make use of the signed option trading volume from ISE. This is a small part of our sample for sure, but again, if we can find some results, that will be great. This signed option trading volume is like the order imbalance. Okay, so if you have a more positive signed option trading volume, by definition, according to the equation here, there are more buying pressure. Okay, so there are higher demand for those options. And this is indeed true for the options of stocks with low ESG performances. For the P1 portfolio, the net demand for call and puts are all positive, even though according to the literature, those public customers should have been the net sellers. But for this specific portfolio, they are the demanders. There is a higher demand from the option traders for the options of the stocks with low ESG performance. And as you can see, the signed option trading volume that gradually decreased until to a very negative number, leading to a quite negative spread. Okay, so with this table, we show you that our finding is related to the option traders' demand. So why the options of low ESG firms are more expensive? Because there are higher demand for it. It pushes up the price, leading to a lower delta-hedged gains. So I don't think I have much time. Let me just go through the underlying channels a little bit. Okay, so we look at different business models and product market competition. If a firm is operating really closely to its customers, then ESG matters more for it. We find a stronger results. If the firm is in an industry with a very strong product market competition, in this case, ESG could be a competitive advantage. We also find a stronger results. Investors' attention on ESG issues also matter. If a firm is operating in a democratic leaning water state, okay, it means the citizens or the politicians are paying more attention to ESG issues. In this case, we have stronger results. And the corporate hedging policy kind of reduce the effects of ESG on the option pricing. So I'm going to skip those 3 slides. They are cross-sectional analysis. Yeah. And one concern that you may have, and a lot of people will have, is that whether our results are going to be driven by carbon risks. As I mentioned earlier, there is a nice paper showing that option implied tail risks are larger for firms with more carbon-intense business models. Our results contaminated or just a side effect of their findings. To answer this question, we control the carbon emission score in our baseline regression, which is the Macbeth regression with delta-hedged option returns as the dependent variable, right? So as you can see here, when we only have the carbon emission score, indeed, we are finding something similar to ISV in this paper. But when we include ESG performance here, the significance of ESG kind of remains. However, the significance of carbon emission diminishes a lot. It's no longer significant. So we can make sure that the ESG is a broader concept, and in the context of option pricing, especially for data hedged gains, the ESG is probably more important than the carbon emission. All right, so let me conclude. In this paper, we show that the implied volatility is higher and data hedged option gain is more negative for firms with poor ESG performance, indicating that for those firms, the option prices are more expensive. This is driven by a higher end user demand. All of the components of ESG contributes to the expensiveness of the options. We have an ESG premium of around 0.3 per month. Investors are hedging not only about the higher moments, they also hedge about the volatility risk. So we know where does the premium come from. And we have a lot of cross-sectional tests, which I just explained to you. All right, so this is all I have. I hope I'm on time, and I look forward to your questions and comments.
Perfect timing, I think. We do have a couple of questions in the chat. So I think Pedro Ares asks the next excellent question. So you're talking about ESG scores, and you show that different low ESG stocks and high ESG stocks have different volatility. But for us, people in the options literature, would be also interesting to see in what other dimensions do they differ? Like, do they differ in size? Do they differ in other things? So that's,
yeah, I think this is a, yeah, it is a great question. It is a great question because the ESG performance of a firm definitely is endogenous, right? And there are some literature talking about what determines the ESG, but size doesn't seem to be the important feature. Yeah, so when we look at the distribution of the ESG performance of firms, the high ESG performers include both the very large and the small companies. So it's not very clear. It's not very clear for this size kind of effect. You may find some slightly positive effect. Larger firms may have more resources to do the ESG, but it's not a very solid conclusion yet, I think. And for our analysis, yeah, I understand your concern that we may have some kind of results driven by other firm fundamental. One thing that we have done is to control, of course, control for firm characteristics in our regression, and we still find the results. And another thing that we can make use of is the exogenous event occurred at firm level. right? So we can match the traded firms with the control firms in the firm fundamental, make sure they are similar before the event, but only the traded firms experience an increase in ESG risk. So that is going to be my response. But I understand that we could show more comparison for firms with high and low ESG performances to give a more comprehensive picture to our reader or the audience.
Perfect. I think we're done with the questions in the chat. So if anyone wants to ask a question via the microphone, feel free to go ahead and unmute.
Hi, Steve Figluski here, Xintong. Very interesting
Hello,
paper you've come up with. You can't see me waving, but in any case, you've come up with a lot of interesting results. And I'm jumping in quickly, and I want to give you about 3 comments very fast because I have to leave in about a minute. The first one is that I think it's really interesting to be looking at the implied volatilities in addition to option returns. I think that's a way of getting at risk that may or may not actually be priced in the market. It seems like your results show that it is priced in the market, or to just support that anyway. But even if it isn't, if there's an effect on volatilities, that's worth looking at by itself. And if you start looking for volatility effects, and what your argument is basically that a lot of these should be coming from risks of jumps and blowups and, big events, then the place perhaps to look for that in the options market would be in the out of the money options, the out of the money puts. You could at least bolster your story by looking at the slope of the vol skew in addition to the at the money implied vols. And on the last point, I'm sorry I'm hitting you with all of this at once, but I really do have to leave in 60 seconds. And the last point is that I think you could probably get a whole lot more things to look at by focusing a little bit more on the event study. For example, if you're looking for an event having to do with the Me Too movement, you could think of a bunch of things like somebody like Cuomo being chased out of office because of this, or I'm not sure what they call it, but the march right after Trump's inauguration, where millions of women showed up in the streets of Washington. These are events where you could actually do a kind of an event study on it. So anyway, those are my thoughts. I had a couple others that I will send you an email about. I apologize to everybody for jumping in and taking up everybody's time, but I got to go. Anyway, nice paper.
Sure, thank you, Steve. Thank you for your comments. Yeah.
Yeah, we have a couple of questions in the chat. So Stefan, if you want to ask yours.
So just to also to connect with Stephen's point on the event studies, right? I mean, you can of course look at aggregate events that affect everything, but also you could look at events that only affect some of the firms, right? So you have some, cross-sectional evidence. And what I was thinking of was ESG rating changes. So there are some papers that look at that, and I think that might be interesting. When the ESG ratings changes, then you have a direct comparison what happens around these events. So that might be some idea to potentially look into it.
Yeah, nice comments. Thank you, Steve. Thank you so much. Yeah, I will look at the ESG rating change to see whether we can do something related to it. Thanks a lot.
There is also a question from Nick Pan, so he has background noise. So his question is, you're looking at 1 month return because, of course, that's the standard for this kind of option return regression. But does it also make sense to look at longer term option returns, or just kind of look at other option return horizons?
Yeah, I think in the paper we have a session talking about it. We have a little bit weaker results when we look at the longer term options. But let me check. I'm not very sure about it. But definitely we have checked this thing. And as Dimitri said, we want to be connected with the standard literature. That's why we focus on the at the money options. And for the longer term options, they are a little bit less liquid, and the information reflected is probably maybe a little bit more noisy, but definitely I can check. My memory, which is not very, very precise, is that we have a little bit weaker results for the longer term options. But I think we have some results. It's not like totally gone. Yeah, but let me check.
Well, if Christian and Neil don't have more questions, let me ask one question real quick. So I assume that those ESG scores are relatively sticky, so they're persistent, and you seem to have like some power issues in some of the tests. So does it make sense to maybe extend those scores, extrapolate them backward, kind of assuming that they're the same as in 2014? The advantage being is that those ESG risks were kind of less of the issue in people's mind in 2000s and 90s, and to the degree that we can extrapolate those backward, we still have option metrics data, we still have option returns to potentially look at. Just an idea.
I think this is a great suggestion, and I agree with you that the ESG scores are a little bit sticky, but in the Thomson Reuters SS4 data, at least they argue that they are going to update the data once there is any incident or not. So it seems to be okay. And we do have some statistical power in some subsample tests, as you said. I think we can do some extrapolation of the ESG score to the earlier days. And your expectation will be that in the earlier days, people don't pay much attention to ESG issues. So the option pricing should be less affected, right?
That would be my intuition, but well.
Yeah. I think this should be the right way. Yeah, let me check. At least the effect should be weaker, even though maybe there still be some kind of effect. I can check that. Thanks, Dimitri.
So Dimitri had another question in the chat that I don't know. I'm sorry I missed the first part of your talk, and you may have already answered it, but I'm curious about the answer. So your results are about options returns. And so options have embedded leverage, right? So how high in dollars is, what's the effect in dollars on the option price? 1 cent, 2 cents, 10 cents? So how does this return map to dollars?
This is a nice question. Actually, I don't know the answer. I need to check. I only know the magnitude of the return. The premium is 0.3%. But given that the option, but it also involves the investment of the stocks, not only the option price. So
yeah, that's why. This is why Neil asks this question. So one of the advantage of computing return your way is it's kind of robust and it's monthly, but because you normalize by delta times the stock price, it's not, you cannot transform it into dollars very easily. So it's useful to have both numbers.
Okay, I can check that. One robustness that we have in our paper is that we also use the straddle returns. So we only have the options, not the stocks. For that one, do we have a scale? Let me check. Anyway, I think this is a nice suggestion to have the dollar kind of sense of our economic magnitude. Thanks, Neil.
Yeah, on that note, Xintong, will thank you very much. I know that it's already like 1.5 back home, right? So we'll let you go to bed, and we thank you very much for the presentation.